Hello investor, how are you? Hopefully you are doing very great. And today's in video I will cover the Raytheon stock valuation. This is the company symbol, and myself Pramod Kumar. I am a CFA charter holder and FRM certified. Okay, so this is the defense stock and deal in the aerospace industry, especially in the US, and heavily deal with the government, right? So if I see in the total yield, which is the price return, and for the last 10 years, the year over year growth is plus the dividend growth, which makes the total return or the yield of the stocks, it is the 10.04%, right? And but if I see the recent 5 years, the same, it's increased over 2% or almost 3%, right? 12.71 percentage. So that's not bad for the non-technology stocks. So this is the agenda, and we'll go one by one on it. So why I have picked it? So the reason for my pick this is simple, that we can see the stock really crashed and during the COVID-19, when every other stock crashed, it was trading above 90, as you can clearly see. But even now it hasn't picked up back yet. So right, so it come back, but almost like 40 42, but then immediately goes up, and then it's fluctuating around the same, and at the moment it's $57.60 the price, right? And still seems like it's going down. So this is and pretty much if we see the history, yeah, it's pretty go up, and I already show you the total yield, right, for the last 10 years. Okay, so let's see more on to this. What's the return in equity, or return on investment capital? So the return on equity of this stock, it was very good, but now it's declining mode, as you can see here, right, until December 2019. Similarly, on the return on investment capital, if I compare with 10 years ago, it was over 10%, and now with, you can see this one, it's close to the 5 point some percentage, right? So it's pretty much half of what it used to be. So let's see some quick the margins. So the gross profit margins, which we can see in the blue, and the EBITDA margin, EBIT margin, and net profit margin. So think from this, these are the top level, the gross margin from blue, and the right is the bottom line, right, which is the net profit margins. If I compare from, for sure, the 10 year ago to now, the company is again, the gross margin for 2019 is huge, spiked up over 20%. But if I see in the past, it was not so great. It was up and down, down, up, and negative. So it's very fluctuating in terms of the gross margin. And the net profit margin, even it negative, you can see in 17, 18, and 19, it's just come up. So it's a very heavy volatility in terms of the revenue. On the liquidity check, it's not bad, is over 1. So for example, in the short term basis, if you have expenditure of $1, so the pure cash the company has, think from 2019 December, is only 60 cents, right? So that's easy to visualize. And but the company still have the some assets, so over $1, so which is pretty good. So that shows under blue line, which is the current ratios. And I on my channel, I do have the video of how to calculate, analyze all other, not only the liquidity stocks ratios, but also these margin as well. So feel free to check it out. On the risk side, it's depend how you take it, but 69% of the revenue is depend upon the US government, especially in the Department of Defense. So if everything goes right, this is a very good thing. But if especially in this kind of economy, when the governments are in huge debt, and the US economy is no different on that one, so things dependent on one big even if the is the government, but depend upon one big your consumer is from that perspective is if you see the portal principle, right, it's not a very good or healthy thing. So this means major part of the revenue can be slashed quickly if government decided to cut it, right? So the company will be in the bad shapes. So think from that perspective. One more thing I like to highlight before I go and show the intrinsic value for the using the last 10 years is the recent issuance and purchase of the stocks. If you can see this chart, the company doesn't do any issuance and purchase since 2012, and then boom, suddenly because of this COVID-19 and Corona, the company has to raise, you can see, almost double the amount of its value, right? So that's why maybe one of the reason is share price crashed. So it was around 800 million share, and now it's 1.53 billion shares. It's so pretty much almost same amount of value the company has gone, and basically whoever owned this shares, it's because of this issuance of shares, its value get half, right? So simple math is that. Okay, so these kind of a thing is also very good to see for not just to share price or the enterprise. For me, I have the models ready. Usually I just I can plug the number and get the price out, but that's only the numbers basically won't give the full picture, right? It gives some value, but in order to understand the value behind it, what makes those number, for me, I really need to see from all the angles, from the top level returns, or from the liquidity check, from the risk perspective, what company is issuing, future perspectives, customers. So these are the things. So whatever I usually look, if I plan to add in my personal portfolio, the same thing I'll does in this video as well, right? But pretty much more in the diluted form, so it can be easily understood by the common person. At least I try my best on that. Okay, so next is to calculate the intrinsic value. For this time I will use two models, and then we'll do the so let's do that. So I am on the I have opened the enterprise value model. Usually I use the net profit model and enterprise value plus free cash flow model. The reason for me not using the net profit model is because the company is predicting loss, so there's no point in using that model. So I'll use this model. Okay, so I have taken the last 10 year of data, and the last 10 year of data, you can see how the price increase, and then these are the market cap. So market cap is nothing but the average share outstanding. If you multiply by the price, you will get the market cap, right? And then these are the total debt, whatever the total debt I can able to get on the interest bearing. I'll just sum it together and just throw it the number there under its year slab. And then these are the total cash. Pretty much the total cash, I have taken the very liquid cash plus also the short-term securities, right, which is pretty liquid as well, like GIC and all. So sum it together for each year and just throw it the number there. To compute the enterprise value, it's pretty straightforward. Just take the market cap plus the debt and reduce any cash. So think from that perspective. If today you have 43 or like $104 billion, so you go and then just simply buy this whole company, right? So that's what it says. But if you can see, the enterprise value is over 10 years, its growth is 9.20%, right? And with the last 5 years, its year-over-year growth is 14.14%, which is not bad, right? But the problem here is, which I easily see and which I'm also projecting here, the growth is coming from the debt. The company is raising significant amount of debt to come up with this enterprise value, right? Which is not a healthy sign. Look at the debt ratios, over 15.5%, and with recent 5 year is even increased to 16.4%. So these kind of things also need to see to invest in the company or not. And we can easily see from debt over EBITDA ratio that now the debt is pretty much double, or right, from what it used to be 10 years ago. So 1.26 times of it earnings, EBITDA, and now it's 3.42, which is huge. The enterprise value of our EBITDA is not that bad, but until 2019 it takes 8 years to so the company is generating good earning before interest and tax plus depreciations. But with the recent year in 2020, we have 2 quarters of data, and then I projected 6. This means if you can easily compare the 2020 estimate, the year end, which we don't have it, so the company is already losing $2 billion, or almost $3 billion, right? $3-4 billion in the EBITDA. Okay, so now the next is I have projected 10 years of the EBITDA using the growth rate of EBITDA growth rate of 4.51%, which I have taken the 10 years CAGR, right? And then reduce the growth rate to pretty much shred the growth rate and to bring it to 2.26%. Okay, I assume I can easily able to sell the company after 10 years at the 10th year of EBITDA times the average enterprise value of EBITDA, right, to come up with this number. Discounted by 10%, any investment I need at least more than 10% of its value. So that's what I have used here. Right now, at the moment, as you can see from the last slide, it has 1.53 billion share outstanding. So I have used that one and then divide the number enterprise value by this. So this is with my first model, I got this price, $61.81. Okay, so next model is free cash flow model. In the free cash flow model, again, I take the operating cash flow, then just add, then reduce with the capital expenditures, and you simply get the free cash flow. It's simple enough. The free cash flow yield, if you invest in the company, the cash flow yield you can see is 6.4%. So pretty much if you invest right now, for example, in December 19, when the stock price was 94, the free cash flow yield was 4.59%. So pretty much after paying everything, the company is able to generate 4.6, almost 4.6% in terms of returns, in terms of your free cash flow, right? Which is not bad. So if I can see from the yearly basis, 10-year basis, 3.10, but in the last 5 year, the free cash flow, the growth is 5.37%, which is quite good. So it seems like the company increasing, not like very good, but still, as compared to the last 10 years, the recent 5 was good. Okay, so I have taken the growth rate of conservative as 3.10, and I assume I can sell this company after 10 years based on the free cash flow model by 8 times of its 10th years of free cash flow. Again, discount rate is 10%. Then my company value, if I does and divide it, I got $51.79. So I got with my two numbers as terms of the intrinsic value. So let's say what is the final price. Okay. Okay, so the final price is coming as $56.80. So pretty much because we haven't used the net profit model, so I give the 0 weight to it. And on enterprise value and free cash flow model, I gave equal 50% weight. So divide the 50% to the intrinsic value to get the weighted price, sum it together, and this is my price. So at the moment, the price based on this model, the share price is pretty much the same, right? So this is what the price is in the market. So it seems like it's fairly valued at the moment. So yeah, so pretty much that's it from me on this video. So let me know what you think of this stock. This is the defense sectors, and I have covered the risk profile, the cover the intrinsic value, and lot, right, the total yield, the margins, liquidities, and so on. So, and the total returns and the income statement margins as well. So let me know what you think of this. If you're new to the channel, please subscribe to the channel. And there are tons of other videos which I perform the stock valuation. At the end of these video, there will be a playlist. You can simply click there and watch those ones. And there are some other which is the stock analysis as well. I really do appreciate if you can like this video and comment your favorite stock. Okay, so see you soon in next video. Myself, Pramod Kumar, says I'm signing off. Bye for now.